Distressed tech loans are hitting the market. And there's a category of these tech-driven lenders that are getting caught with their pants down in this rate environment and in how they manage their portfolios. We are seeing large sell-offs of their loan portfolios hitting the market. For disciplined note investors, it's not a warning sign, it's a buying opportunity for us. So what's happening to these companies? As I mentioned, they built their model on 3 assumptions that kind of all breaking at once. Rates would stay low, values keep rising, and underwriting could replace judgment that comes from years of working through distressed loans at borrower levels. Now, what are we seeing? Rates up, values softening, investor-owned properties where the math was already thin. People didn't have the revenue to pay these loans. They start going delinquent. And these companies don't have borrower relationships, workout experience, have no idea how to manage through it. The playbook was origination, not resolution. And these portfolios are hitting the secondary market in significant quantities. We're seeing huge pools of these loans, the fix and flip, the bridge, the short-term residential loans coming to market from these companies as they try and raise liquidity, restructure, in some cases, wind down. For a fund like ours that's specifically built to buy distressed notes and work through them and have that in-house asset management team, we work direct with the attorneys. This is an environment that we prepare for and what we've been accessing over the past year. We know how to evaluate these pools. We know what the resolution path looks like. We have the servicer relationships. We have the legal infrastructure. We have the asset management. These tech lenders thought they could automate their way through some of this credit cycle. And in good cycles, absolutely you can. But when things aren't on the conveyor belt and each asset has to be dealt with individually, they can't, because it requires judgment, relationships, patience, specific individual outcomes for every asset. And I want to be clear, their distress is not our distress. When we see these lenders have to sell a pool of loans at a discount, pool's got to go somewhere. And we have no qualms about being the buyer if we can buy it at a great price. Now, I do want to say not all of these loan pools are equal, and I want to be clear about that. Some of what's hitting the market is generally impaired. Borrowers in markets where values have dropped significantly, loans with thin equity cushions, properties that need the work that borrowers couldn't fund. We're not buying everything. Now, we are extremely selective. The question we ask on every pool is the same question we've always asked. What's the realistic resolution value? What's the price do we need to be at to make the math and the numbers work across every scenario? If the discount is big enough, even a messy loan has a path. If it isn't, we pass. Got loans that sent to us the other day. We bid at about 40 cents on the dollar. They came back at 70. And the joke from the individual who passed that information along was that was Friday the 13th. So I mention this because there's a lot going on. And I just want to wrap everything now together. Because you're going to hear the private credit market is cracking. The headlines are real. $265 billion in stress. Redemption gates at major funds. Markdowns. JP Morgan. All these large Blue Owl. Growing concerns from analysts who spent years. Everyone, this is the safest trade in finance. The reason it's cracking is structural. Funds that were priced to perfection, lent against cash flows, promised liquidity, they couldn't actually deliver. And now they're discovering what every credit cycle eventually reveals.